Welcome to today's video in continuation of how to study price action and also as well as market commentary on what's happening with gold especially. My name is Rocky Calvin and welcome to Ashland Trading. By now, if you enjoy the content in this channel, feel free to subscribe and share with a friend. So from where we left from last week, apparently I remember the week before last week, I had marked this P raise, for example, this bullish P raise, this bullish fair value gap, and we also had a bearish fair value gap. So price was kind of ranging between these two areas. Then coming last week, now we started pushing lower from this Monday. And I remember last week talking about in previous video talking about we are likely to go lower because I did not like how Friday of the previous week closed right there. I don't like this. So this was a sign that we are likely going low. And I talked about if you are going low, the PD rate to target was this liquidity right there, and also this liquidity line right there. These are daily swing lows or daily HSLs. And from the look of it, we are likely we might just tap this because I personally did not really like the idea that gold is coming to take this low of 2nd of February. But from the look of it with this price action, I can't really say much about it because if I decide to grade it, let's see if we grade it, if we displace below the consequent encroachment of yeah, kind of. So I can't really say anything, and you see the way we closed below right there. So I can't really say anything about gold failing to I mean gold going higher. So still very bearish on gold, and apart from being bearish, as you can see, we created a new PD race, which I was talking about. I'd marked this ones last week. So this week, we created the one on Wednesday. We displaced, and this was a confirmation. And now some traders, or in most scenarios, from what I taught in or what I taught in the previous lecture about market structure, you would call this breakout structure. This one right here. This is a breakout structure with a displacement. So you wait for price to come back to this level, then drop lower. So as of now, the market did not really come, back to that level. So we can expect a little bit of retracement because this is a breakaway gap. We can expect some retracement of price to this level in this coming week. Then we drop lower. But I'm generally bearish on gold. If we take a look on, let's say on weekly, because maybe weekly would give us some really good direction. You see how weekly we dropped. This very very bearish. This one. So yeah, we just gonna be looking for most likely this period risk right here. So don't be surprised when gold hits 3,000 again. Don't be surprised. This can happen because we had some video race right here. That way this is now on a weekly time frame. So yeah, we might push that lower, but the big challenge that we're having right now is this geopolitical factors, the war that we're in World War III, and it's the market, especially with gold, has been very, very volatile. Now, with this type of market, if you want to enter position, make sure you enter with very, very small risk because you can you can easily get slipped or you can easily lose a lot even if it did not belong. So I want us to take a look at how you'd have traded this week so that this can help you so that next week when you come into the markets you can be able to know what to do. So first thing first, what time are you trading? It really matters. I don't usually trade Asian session, but if I was to trade Asian session, I would ask myself, where did we close the previous week from? That is on Friday. So on Friday, we closed by creating a gap over here, as you can see on hourly time frame. If I want to trade the Asian session, we had a gap right there. Okay? So this gap right here, when I would trade Asian session, I would wait for price to purge that liquidity over there if I want to send it low because this gap was a displacement and in addition to breakout structure right there. So we were targeting something low. Okay, so market opened up, pushed to the consequent encroachment, pushed lower, but we really did not tap the extreme level of that gap. But now during New York session, this is not really New York still. This is now London. During London session, this was Asian liquidity lying off here. During London session, we come and take liquidity above here, tap into that gap where we were supposed to be selling from, then price drops. So when price drops, we had liquidity or the swing low. For example, this one here, this was a target, and this one was a target. Price never went to the extreme one. It only tapped this one here. So I mean that if you are selling from here, so it would have been something like this. It would have been a short from there. Stop loss be high above this high right here. Then you'd have targeted some partials from this level around 1 to 4 R. then maybe target, this other PDRA that is, below this one right here. So that would have really worked. I don't know if I could see it on maybe lower time frame, but let's just work with this one. So yeah, that would have given you a 1 to 4 hour win. And if you're targeting this other one, would have been around 1 to 5 hour. So pretty much this was not really tapped. Price went on back high, but still this stop loss was never touched. As you can see, we went higher the next day, but still dropped to deliver that very next, actually Tuesday, never delivered, but delivered on Wednesday. So literally, you don't really have to, target that much. You can just target this swing low 1 to 4 hours, then you walk away clean and such. Okay, yeah, just something like that. So apart from that, that's how you'd have traded this. Now, if you are trading, let's assume New York session, this is what you would have done. You would have marked Asian liquidity, which is this high right here. This Asian liquidity, no, sorry, this London liquidity. Remember, London liquidity took Asian liquidity, then dropped. So we in New York right now. This New York, remember, I'm using UTC plus 3. So this might be different with what you're used to using, especially if you're in a New York time zone. I'm using UTC plus 3. So whatever you're seeing here, don't be so confused. Like, why are you seeing 17 p.m. yet this is not like it doesn't really match with what's on your charts? Okay, so I'm using UTC plus 3, as you can see over here. So that being said, if you are trading New York, this is what you have done. You'd have marked this liquidity, this swing high right here, and you mark this low, this newly created low here, right? This one here and this one. Okay, so this was our liquidity that we're supposed to be targeting once this has been targeted. And remember, we were bearish based on what has happened on previous week. As you can see, this was a breakout structure, and the market is creating lower lows, lower lows. Okay, so what would have happened here? We would want the price to take this liquidity up here, which it did during New York. This was around in New York time. This is around to be 9 a.m. This is a 9 a.m. candle. This one right here. So definitely 9:30. The New York Open is within this candle. The only difference is that this is now hourly. So we took liquidity above that high, tapped again into that gap still, and you see price reversed and came all the way down. Unfortunately, we never delivered over there. So the next day came in, and you see price the same thing. So when you're trading the next day, you're just resuming from where you left from. You're asking, okay, what did we leave unfilled? This delivery to this lower side did not happen. So this day we also look forward for sell. So for example, if you want to trade London, you're going to be asking yourself a question: what PDA do we have here? We had this liquidity right here, this one, and we also have what? Some swing high right there. So we want to see price taking off this. For example, price took this one, but you see this was more of a displacement because you created a new bullish PDA that bullish gap, this one here. So this bullish PDA, this simply means that we are not supposed to be selling after this liquidity has been taken, because now this is a displacement. This is not a liquidity grab. Okay, this is not a sweep. This is not a liquidity sweep. So price is likely interested. We ask ourselves, where is it likely to go? The way this displacement has happened is this PDA. So coming from here, now we take that high, and I believe this was New York. Yeah, sorry, London. So London takes on liquidity from Asian previous day highs, manipulates previous day highs. That is how manipulation happens on Tuesday. Then we drop down. So assuming that you're just patient and you're just waiting, now after dropping down, we create a bearish P area right there. You see this one? This is a bearish P area, bearish fair value gap. So you mark it, and immediately we also fill this bullish one and we disrespect it. Disrespecting this bullish P area right here, this one, shows a sign that we were interested in going lower because we never respected it. You see how we displaced aggressively against it. Okay. So when some people were thinking these are breakout structure from this level, now these are bullish one, then you're going higher. But you need to pay attention on how we closed under this PDA. This one, this gap right here. You see what happened to it? We displaced, meaning that we are interested in going higher. And remembering that we had not yet delivered to liquidity down here. We have liquidity lying. These are literally relative equal lows on hourly time frame. This one's here. So this is liquidity present there. So we start looking for sales using this new PDA. So using this new PDA, if you're a new trader, you really don't want to have a lot of optimal entry levels. Like you just don't want to filter so much about your trading. This is what you have done. You enter on that gap, or even you put a limit order, put your stop loss on this high. as much as it is too high, but this will give you little risk reward, but yeah, you're gonna be way safer. Then target the opposing liquidity. For example, this liquidity that was left untapped, this is now what you target. Yeah, so what you do is you just enter from there and you target this liquidity down here. You see that already that would have given you 1 to 3 hour. So if you're looking for to passing your challenge, assuming that maybe once price, let me give another secret for traders who now who had sold from this level and maybe from this level and were targeting this bid array. Once you see price has attacked one of a bid array, for example like this one, now start moving your stop loss to break even or come and secure some profits over there. Okay, so that if it goes back at least this day, you've secured something. So you only wait to re-enter again. But if you had entered here and you see it was never delivered, you'd be just waiting for that to happen. So when this happens, you just add another positions right here. Then you target the same. So literally, you made that 1 to 3 hour and also 1 to 4 hour release. That's at 2 or 7. This is how you'd have entered this trade. Now, assuming that you missed that trade, let's see what if you'd have had something during New York session. Now, this New York session right here. So New York session, what we'd be looking for, what would you be looking for is a period way for first use to send it low again. So for example, right here we had a bearish period way. We had a new one here. We had a bearish fair value gap right here. We just marked it. It was kind of tiny, but yeah, it's worth it right there. I haven't really marked it properly, but I hope you guys can understand it. For the new traders who still don't know what a fair value gap is, please go learn some fair value gap. I think I have some videos on this channel, or you can learn it from whoever else. What matters is that you get the point, okay? And this PD array, you see how price respected it. There's nobody that did the damage up there. It was just the wicks, except for if you had put your stop loss from this on this high, you'd have been stopped out like this one, as you can see. So in this scenario, this is now where the concept of time and price comes in. Because if I move into lower time frames, now you'll be able to understand exactly why some people are stopped out of here. It's not that they were wrong, but they're in the wrong place. Like they're in the right place at the wrong time. Okay? They understand the narrative, but now they're entering these cells at the wrong time. For example, if you sold over here and you're putting a stop loss above here, you'd have been stopped right here because of time, the confluence of time. I'm sure this was 16:30. 16:30 is 8:30 New York time. So 8:30, there's always some volatility right there. And that volatility went to take out these highs. You see these ones? These ones. Then we drop lower. So why was it going to take this ones right here? It's going to take out these ones because this was London liquidity. Yes, this London liquidity was resting around somewhere here. Partial. Actually, this is not really fully London liquidity because London began from I think from this from this country here, but there was some liquidity over here. Uh, but this liquidity is still part of London, so yeah, it's still London liquidity. As much as not the one that you're used to above there. There's a difference between internal range liquidity and external range liquidity. London liquidity can have both internal range liquidity and both external. So what you're seeing out here is external liquidity and this internal liquidity. So price jump up there during 16:30, I presume, which is 8:30, and you see we take liquidity over there, then we drop low. So if you are a trader, you will see this happen. Then you're waiting for this candle to close back in. Then look for maybe 15 minutes fair value gap and sell it. And as you can see, price drop, but we're able to put that liquidity over there. So you're just supposed to be looking for signals. Now on lower time frames, for example, maybe 15 minutes. Let's see 15 minutes we have something to use, and yeah, here we go. I'm sure there was something to use. So once we take this, the candle took liquidity over there, and you see we now are just looking for something to push us lower. If there's nothing on 15 minutes, you go to 5 minutes. But on the other hand, as you can see, we created a bearish one right here finally, but this was kind of late. Okay, so this PDA, this bearish one, is what you'd have used to sell. But now selling with this one, you put your stop loss above that high, or maybe above this high up there, which isn't really such a good, risk reward. Because the next day we just opened and we took liquidity from up there, then we dropped, price again come and take liquidity up there, then we drop. So literally, this is how you would have managed this. But I'm very sure if you move into 5 minutes time frame, there must be something here. Let's say on 5 minutes. There must be something here that would have given traders, entry. Now on lower time frames. Once you understand the higher time frames narrative, you can now move into lower time frames and seek. Let's see. Here we go. This is This the the candle that took liquidity off there, and you see, yeah, we had something. As you can see, this is now an inversion gap, and this most of the time these type of gaps are usually very powerful and very strong to hold the price. As you can see, price never. I don't think price ever came back to them. Yeah, we never came back there. You see, it just dropped. This one, it never came back here. It just dropped and dropped. Okay, so unfortunately, most people would never know where we're really dropping that low. But yeah, if you had marked this period raise on daily time frame, for example, you know exactly you're targeting. Let me show you. You knew exactly you're targeting, for example, this liquidity and over here. And this, you'd have really made a lot of money. A lot of money. You'd have really made a lot of money. Because now imagine you got this sniper position on Tuesday after we've manipulated the the Monday highs, and now you're sure that like you see the market structure is bearish. Okay. So for example, on 5 minutes, we've taken liquidity up there. Okay. We've taken liquidity up here and also up here as well. So we've taken liquidity, and price is displaced below this one, creating this bearish gap and also disrespecting this PWA, this this bullish one here, right? Okay. So some people would have been waiting for a break of structure, then they enter on the, for example, a break of structure in this area, then they enter on the retest. Okay, a break of structure like this, then they enter on that retest, targeting low. But you see now that day did not really deliver. Price played around there, then the next day is when the drop really started happening. But still, you'd have just entered. Once you see this disrespect of this gap, because you have taken liquidity, just enter on that gap, because this is now a very serious gap, and most of the time this gap I usually never fill. As you can see, this happen because this is now an inversion. We disrespected this period. So you just enter there, put your stop loss above there. So it would have been something like short something like this, for example. You just enter from that level, put your stop loss above this side, because most of the time this gap is not supposed to be filled, and even if it is filled, they are usually very strong. Put your stop loss right there. Then you're going to be targeting these lows that were never really delivered. For example, right there, this one's here. That's around 1.7 hours. So you can take this as your partials. But if you had the guts to hold this towards this PDRA, this daily swing low, you'd have held it till that level. It delivered on Wednesday. But if you still have more guts and you know exactly what's happening now, after this day, you move your stop loss to break even, secure profits from this level. Some profits, or maybe you secure this level, this 1 to 7 R. You see from this level here, this 1 to 7 R from that level. You put your stop loss right there. Then you let it run, targeting the next bigger wave on the daily time frame. This one right here. See what you've made? That was around be 1 to 52 R. Some people say it is impossible. Yeah, but this one single trade would have given you 52% returns, risking 1% with just a single trade. And then it runs. Then the next day, Thursday, delivered. Then after Thursday, now take away the profit. But if you still have the cards, you want to hold it further, good. Take profit down there. That's where it's headed to, apparently. And that's what 1 to 88 are. Some people say it is impossible, but guys, here I am telling you, here I'm showing, not really telling you, here I'm showing you. You see this entry has been filtered from the daily time frame, understanding what's happening. We went to hourly time frame, we went to 15 minutes time frame, and now 5 minutes time frame. Now you guys can see it. And these setups are always there. They're always there, like every single day. It's the same exact thing here. This is now Wednesday. Just mark some liquidity over there on specific time. We take liquidity above this high. This one. This was now Asian session. We take liquidity. Though it was little, but this means something. As much as we just purge it a little bit, yes, I know this is not really that good, because prices seems like when most of the time when price do this, it means that price is extremely bearish. So after that, we drop, we create this what? This bearish gap. So now you wait for price to come back to either that level, consequent encroachment of this gap, or up there, put your stop loss up there, then a drop comes on. In case you miss this one, you just wait for again, look for a bearish gap that's been created. For example, we had another one here, this one right here. You end on it, put stop loss up there, then drop it. So this type of setups really requires high knowledge of time and price. It's the same thing here. Once you understand we're bearish, you look for bearish PDRA, for example, like this one. Price came back to it, But now this was a displacement. You see, this is a displacement gap. So price should was supposed to be coming to that level. You sell from there, put stop loss up there. See what happened. Delivered. This is how you'd have traded this. So it was about sells, sells, sells. And this is what happens when